It's 6 a.m. on a Friday in March 2023. A startup founder in Austin checks his phone before coffee. One message, 4 words that ruin his morning. SVB is going under. His company's entire $4 million in cash, the money meant to pay 40 employees in 6 days, is sitting inside a bank that federal regulators are about to shut down. He is not alone. Thousands of founders are waking up to the exact same message. This is the story of Silicon Valley Bank, the 16th largest bank in America, the quiet financial plumbing behind nearly half of all U.S. venture-backed startups, and how it collapsed in less time than it takes to watch this video twice. By the numbers, $209 billion in assets, $42 billion withdrawn in a single day, gone in 48 hours. This was the fastest major bank collapse in American history, and it started with a bet almost nobody outside the bank understood. To understand how this happened, you have to understand what SVB actually was. Founded in 1983, it wasn't a bank for ordinary people, no mortgages, no car loans, no branches on every corner. It was the bank Silicon Valley built for itself. When a startup raised a funding round, the venture capital firm often required them to bank with SVB as a condition of the deal. That gave SVB an almost captive customer base. Thousands of startups, all parking huge piles of investor cash in the same institution, all at once. By 2021, in the middle of a historic tech funding boom, that captive base turned into a flood. SVB's deposits nearly doubled in a single year, from around $102 billion to $189 billion. That's an almost unheard-of growth rate for a bank, and it created a problem most banks would envy: too much cash and nowhere obvious to put it. Silicon Valley Bank's business model was simple. Startups raised huge piles of venture capital cash, parked it at SVB, and SVB, flush with more deposits than it knew what to do with, invested a huge chunk of it in long-term government bonds and mortgage-backed securities. That's normally safe. Boring, even. But there was a catch. Those bonds paid a fixed, low interest rate, locked in back when interest rates were near zero. Then the Federal Reserve did something almost unprecedented. It raised interest rates aggressively again and again to fight inflation. Suddenly, SVB's safe bonds were worth far less than the bank paid for them, because new bonds paid so much more. On paper, that's just an unrealized loss, not a crisis, as long as nobody asks for their money back all at once. And this is where the story turns from a spreadsheet problem into a bank run. Here's the part that regulators would later scrutinize hardest. SVB didn't hedge this risk the way most banks its size would. Internal risk managers reportedly flagged the exposure to rising rates for months, but the bank had gone without a permanent chief risk officer for most of 2022, nearly 8 months during the exact window when interest rates were climbing fastest. A bank sitting on that much interest rate risk, with no one in the seat whose entire job was to manage it. By early March 2023, tech funding had dried up. Startups were burning cash reserves faster than they were raising new money, which meant they were pulling money out of SVB just to make payroll. To cover those withdrawals, SVB had to sell some of those devalued bonds and lock in a real loss, $1.8 billion. On March 8th, SVB announced that loss and said it needed to raise $2.25 billion in new capital to shore up its balance sheet. It was meant to look like a routine fix. Instead, it looked like blood in the water. Silicon Valley's venture capital world runs on group chats and founder Slack channels, the same tight networks that made SVB so dominant in the first place. Within hours, prominent VCs were privately telling their portfolio companies one thing: get your money out, now. This is the part that makes SVB different from almost every historic bank run before it. In 1907, in 1929, people stood in physical lines outside banks. In 2023, the run happened entirely on phones. A wire transfer takes seconds, and a rumor travels at the speed of a tweet. By the end of March 9th, customers had tried to withdraw $42 billion in a single day. SVB's stock had collapsed 60% and kept falling in after-hours trading. Regulators didn't wait for Monday. On the morning of March 10th, they seized the bank. And for thousands of founders, that meant one terrifying question: was the money they needed to pay their employees this week gone for good? Under normal FDIC rules, only deposits up to $250,000 are insured, and the vast majority of SVB's deposits were startup operating accounts holding far more than that. In fact, roughly 90% of SVB's deposits sat above that insured threshold, the highest exposure of any major bank in the country. For a weekend, it looked like companies across the country might lose access to the bulk of their cash, with real payroll and real jobs on the line. But the panic didn't stop with SVB. Within 48 hours, Signature Bank in New York, a lender with heavy exposure to crypto deposits, was seized by regulators too, becoming the third largest bank failure in U.S. history at the time. Days later, First Republic Bank began hemorrhaging deposits from the same wave of fear, eventually collapsing 2 months later in what remains the largest bank failure since 2008. One bank's collapse had turned into a full-blown regional banking crisis, all traced back to the same underlying fear. If it happened to SVB, who's next? Regulators stepped in with an emergency move, guaranteeing all deposits at SVB, insured or not, to stop the panic from spreading further. It worked, but it also reignited a debate that's still going. When a bank fails because of bad bets, who should really be protected? And who ends up footing the bill? Regulators insisted taxpayers wouldn't foot the bill directly, funding the backstop through a special assessment on other banks instead. Critics argued it set a precedent that sufficiently large, sufficiently connected depositors would always get made whole, no matter how the bank failed. Silicon Valley Bank didn't collapse because of fraud, or a criminal mastermind, or stolen money. It collapsed because of a bet on interest rates, a crack in confidence, and a panic that moved at the speed of a text message. That might be the most unsettling part of this story. You don't need a villain to bring down a bank. You just need everyone to believe at the same time that it might fail. If you want the next collapse story before it goes live anywhere else, subscribe.